Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most? And do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right. No extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
All right, welcome to The Wealth Flow. My audience is going to love today's guest, Sergio Altomare. He is the CEO and co-founder of Hearthfire Holdings, along with his wife, Corinne, a boutique real estate investing and management company. In 8 years since starting the company, he has built a portfolio of more than 50 million in assets under management and syndicated over 12 million in assets, returning 2 million in profits and 25% IRR to their investors. Their investments have spanned over the years in commercial real estate, multifamily, retail, and now have a primary focus in self-storage. Sergio has also flipped homes, rehabbed properties, and done some multifamily development. So, Sergio, welcome to the show.
Thanks, Keith. Good to have you. Good to be on.
Yeah, good to have you. Yeah. Good to have you as well. All right. So maybe to start out, Sergio, if you don't mind just telling a little bit about yourself, kind of where you grew up, and you're one of the few people I know that is in business with their wife as well. So that's kind of exciting. But yeah, share a little bit about yourself and how you grew up, and then how you eventually came into real estate.
Yeah, sure. So I was in Philadelphia, born and raised, with the exception of 2 years where I lived in Italy. That's where I spent the first 30 years of my life. Went to all Philadelphia schools, eventually landed a job full-time with the Federal Reserve. I built a career in technology at the Federal Reserve, first in Philadelphia and then ultimately nationally. That spanned 22 years. Along the way, met my now wife. We were dating at the time, and she's originally from Los Angeles and had a family history of real estate. I do as well, but not as direct as Corinne's. And so started acquiring multifamily properties. Quickly realized that it was something that we could apply my technology, Corinne's know-how and ability to sell and lease up apartments. And we kind of started building a platform. Ultimately, we started raising money. It started with friends and family and kind of grew from there, grew the infrastructure. And that was actually 10 years ago. I'm not sure the history you got there, but that was... might have pulled that from a little dated area, but so we ended up pivoting to self-storage in 2018. We rode the market in multifamily. I was doing all my own underwriting, thought that the market was a little overheated, so we were looking at other asset classes and found self-storage and felt self-storage fit where a lot of our strengths and have taken it from there. And our platform now is built to scale. We are adding more direct private equity offerings to what we're doing now, and super excited for where the future takes us.
Absolutely. And as far as getting into real estate, did you start with multifamily, or did you start with some of the flipping and the other stuff?
No, the flipping came along the way, and that was just more of testing other ways of how you can make money in real estate. Ultimately, we started with multifamily because the initial impetus in investing or acquiring assets was that you always want to make sure you have your expenses covered, and can't really do that if you don't have a tenant in a single family home, then you're carrying all the expenses. So that didn't make any sense to us from the get-go. But we started in multifamily and smaller multifamily, duplexes and triplexes and that kind of thing, kind of built up from there. But it really is a matter of what scales, and what we've learned over the years, if anybody takes anything away, is the bigger the challenge, the bigger the scale, the more opportunity there is. So we started small because we had to start somewhere, but ultimately, doing even the single family home flipping thing if you pencil it out and say, yeah, we made money, when you look at what we bought a property for, invested, when you look at the time horizon, it's not nearly worth what we can do now at scale. So that's the biggest shift and difference there.
Yeah, sounds interesting. And so none of the others, you're primarily focused in talking with you before the show in self-storage. But how did you like retail? While obviously you're not still doing it, but how did you like it when you did?
That was more mixed use relative with the multifamily, so it wasn't dedicated to retail.
Got it.
It was mostly smaller scale, not big strip malls. We do have quite a number of folks that have been that, and the same thing. If you don't have scale, then it's there's a lot more risk to it. But
sure,
longer, higher vacancies for longer periods of time, change in negotiation, different lease terms, and all of that. But again, you have to do that at scale for it to be worthwhile.
Sure. And so when did you officially switch over to the self-storage, and what did you see in self-storage that was appealing?
So when we were looking at in 2018, 2017, when we were a good solid going on 10 years into the next expansion cycle in the economy. And what I looked at was typically historical averages is, bull markets or expansion cycles usually are 8 to 10 years. So at that time, we knew that that's what we were approaching. So it was a matter of if the market does shift, what happens, and seeing what had happened back in 2007, 2008 to real estate. We didn't want to be caught in any potential down markets as it related there. So when I was looking at other asset classes, it was what asset classes performed well during down markets, and really was only self-storage that had the actual track record. Now you see a lot of folks throwing around multifamily or different asset classes being recession resistant, just using that moniker. But in reality, only self-storage performed positively during the great financial crisis. So we looked at that when I looked at what levers there were to pull, when I looked at the overall asset class and how it's got a component of real estate, how it's a business component, how it scales, how you manage risks. It was very attractive. We spent the better part of a year learning the industry, and then it was from there that we made the concerted effort to make a full-blown pivot to self-storage. So we sold off all the multifamily assets. Our investors came along. They did very well because the market still was. We had done a really good job of generating the profits and building the value in the multifamily assets. So we just decided to pivot, and so it was really just learning the asset class, educating our investors for the strategic shift and where we saw the opportunity, and they were on board. I mean, people invest with us because they trust our not just us and who we are, but they trust the work and everything that goes into building a premium investment platform.
Yeah, makes sense. And so and as far as geographically, where all are most of your investments or all of your investments?
So we're in 5 states right now: Massachusetts, Pennsylvania, Indiana, Illinois, and Delaware. And we've got some properties that we'll be closing over the next couple of weeks in Virginia. Some other stuff under agreement in Allentown, and so we're kind of a little bit 5 states right now, and expanding geographically and scale as well in every place that we're at.
And as far as the investment themselves, from a unit standpoint, is there a specific buy box for you, or what do you look for in an opportunity so that you can, really add some value to it?
So self-storage is unique in that there's a lot of data points that can help you determine where a market is and should be. A couple big components is what are the market rates and what is the supply and demand for storage in any given market. We don't necessarily look at it in a per unit count, but per net rentable square feet. So a typical facility size has to be large enough where it can support a third-party property manager. That's not something where it's as easy as it is in a lot of other asset classes, because property managers in self-storage have a minimum, a floor in the amount of minimum management fees. So, for example, it might be $2,500 a month. You can imagine if you have to make a certain amount in gross revenue in order to be able to support that management contract. So nationally, the equilibrium for where storage meets the actual supply of self-storage meets demand is about 8 square foot per capita. So for every 100 people in a population, there's 8 square foot of self-storage. That's when supply meets demand. So we look for markets that are undersupplied, meaning below 8 square foot per capita, and in most cases it's far below that, 5 or lower, and it can also support what a lot of our value add plans now is for expanding facilities. And then we look at our market rates, where an aggregate average rent is about $15 a square foot annually for a facility. So if it meets some of those, and then we look at things like median household income, percentage of renters in a given market. So it's very data dependent. And then from there, we look at individual facilities. How can we drive the value? What are all the levers that we can pull? And that's how we determine where to go and what to buy.
Great. And I know the one deal that I looked at. We had met at the Steamboat event for GoBundance and talked about one of your deals, and I think that's how I got on your mailing list for the stuff. But it was not just a single property; it was a pool of properties. So is your investment usually a fund that has multiple properties within it?
No, so typically what we like is, if we go into a market, we want to have the ability to control some parts of the market. Economies of scale matter in self-storage. So if we go into a market that we're not already in, then what we look for is, can we aggregate, can we build and construct a portfolio? In the case of, I'm not sure which specific deal that you were looking at, but if we have the opportunity to acquire multiple facilities at once, then we will bundle that investment together just because, it makes sense. So that's typically our strategy. If we're going and buying a single asset in a given market, then we look at what are the opportunities for us to plant a flag in that market and grow and scale around that. We typically don't go into a market with a goal of acquiring a single asset. We haven't done that to date, and that's typically not what we do. But if that opportunity presents itself, and then from there, it's a matter of how do you manage a facility or multiple facilities and drive down expenses? An area that we can do that in storage is if we have, because of the technology that we have in our operating platform, is we can have a number of facilities in a single manager, single boots on the ground, because so much of it is online and digitized, from finding a facility, finding a unit, renting a unit, signing agreements and everything, and doing that all online and through your cell phone. Now it's just a matter of how do we staff that with as few resources as possible. So take, for example, our Philadelphia or Pennsylvania and Indiana portfolios. Each of those portfolios has a single manager. So then beyond that, we're looking for regional managers. So we use a lot of the models that you would, whether it be in retail and different other asset classes or different other industries, where you can build single resources or lower resources on the ground, and then have regional and then directors and that kind of thing. So regional managers and support territories.
Sure. And you mentioned third-party management. So is the third party the kind of the boots on the ground when it comes to the management, or how do you have that set up? And I guess my follow-up question to that would be, is self-storage? I'm not in self-storage, so I don't know. I know, there's a plethora of property managers in multifamily, but is there, good resources to choose from when it comes to self-storage?
There is. Self-storage is unique in that it's certainly a niche real estate and industry. So it's very intimate, if you will, very friendly, very open. There are there's a fair number of property managers in self-storage, but most of them are national, or at least in a good portion of the territory. So, for example, we use a company called Atomic Storage. Rick and Megan, hello if you're watching this. And they're a smaller management firm, but they're at the same level. We're growing together, so that was great for us. You can use an extra space. You can use a life storage. You can use public storage to manage your facility as well. And then there are a whole host of probably another 8 to 10 very well-known property managers. So it really comes down to relationship from a property manager, and aligning that property manager with your goals, making sure that there's no pieces of a relationship that may get in the way. For example, we were looking at one property manager that had a conflict of interest and wouldn't manage another facility if it was within 3 miles of one of their other existing assets. So that there obviously limited our ability to utilize them. But other than that, there are some pretty solid property management firms out there.
Okay. And then as far as, you mentioned public storage and some of the other big names that you see. So when I'm looking at just a facility that happens to be in my town, is that specifically owned, or as what I'm hearing is maybe they just may manage it but don't actually own the asset itself? Is that kind of how that works? Or
yeah, there's every REIT has a mix of their own assets and third party assets. So they're not all, even whether it's Cube Smart, Extra Space, Life, they're a mix. So they offer third party. So you don't typically know whether it is a corporate owned facility or if it's a third party managed facility.
Okay. And then as far as the ones that you've been purchasing, or maybe just in the market in general, are you purchasing from like mom and pops, or is it institutional stuff, or what are the opportunities that you're seeing out there?
So the ideal opportunity is typically mom and pop. There's still the majority of facilities, probably 70% nationally, are still owned by mom and pop. And we define mom and pop as somebody who owns maybe less than a handful of facilities under single ownership. That's our ideal target, and we look for undermanaged or, expansion opportunity, that's what we are buying. Lately, the last couple of years, the primary value driver has been expanding an undersupplied market. So buying a facility or multiple facilities from a single owner with the ability to expand those. So that's our ideal. Although we are also adding ground up development. So the yields that we are seeing right now are primary in ground up development. Buyers and sellers, especially facilities that are listed with brokers, are still pretty far apart. There's a lot of stuff that's overpriced out there. But because a lot of that, and a lot of that is driven by newer folks coming into self-storage that maybe are coming from another asset class, and they're looking to invest in self-storage. And like every other asset class, multifamily is a great example. People are willing to overpay, whether it because that they have less disciplined underwriting habits, lower cost of capital, lower return projections or metrics that they're striving toward, just different investment philosophy. It can be all over the map. And self-storage, we have some of that, but by and large, your goal is still to acquire at, with responsible pricing. So we do have a mix of properties that we buy, from brokers, mom and pop, some a little bit more advanced operators that have been around for a few years. But it can vary.
Okay. And you mentioned brokers. Do you do anything to reach out to, the kind of mom and pop operators themselves? Like some folks do with whether it be multifamily, single family.
We do some of that, but to be perfectly honest with you, it's we don't have the same manpower or aligning the same resources that brokers do. For the most part, most operators or most owners want to get the highest that they can. We're doing some off market, but some off market cold calling. But I find the folks that are spending the majority of their time doing that, they're looking for kind of tertiary type of opportunities, lower size, nothing that in most cases is not going to be the potential for an institutional quality asset. That's the portfolio that we are building now. Okay. We've got some assets that when we entered into self-storage are secondary, tertiary markets. But those assets are not necessarily the same types of assets that we're targeting today. There's still plenty of opportunity there. But by and large, when you're looking at the types of facilities that we're better off just finding land and developing it ourselves than spending hours on end cold calling owners and trying to find. We do have a sizable, or at least a growing presence in the industry where we know a lot of players, we know a lot of brokers in markets, and a lot of kind of finders, if you will, that are bringing us deals. So we're getting, just because we're not making, we don't have a cold calling campaign, doesn't mean that we're not getting access to some pretty good deals from mom and pops as well.
Sure. And as far as the investments that you're kind of trying to essentially for the exit package up to institutional, what does that look like? I mean, what will they look at or consider as, a potential buy?
Yeah. So when it comes to the large scale platform, capital partner that we're looking for now. You can only scale so much and so fast at a retail level. So, and what I mean by that is that what we're building is an elite team to deliver fantastic returns, and that's great for our retail investors. But we're also looking to attract larger institutional type of investors, and what they are looking for is your ability to execute. And that means you got to have your I's dotted, your T's crossed. You can't have somebody that's kind of moonlighting and doing this on the side and that type of thing. So the team that we have built is really for scale. Institutions, if they're looking at assets, they want top 50, top 100 major metros. They want certain size assets. They want certain vintage assets. They want outsized returns. So when we're rolling up our portfolio, it has to be sizable enough for an institution. An institution's they don't want to write a check for less than 15, 20, 30 million dollars. So it has to be sizable from that perspective. And then from there, it's got to be a portfolio that has a fair amount of quality to it. So it takes a fair amount of time to be able to do that, and it's executing one property at a time down to one tenant at a time to drive revenue and build that portfolio and construct it to where it's got a tremendous amount of value, not just to your investors now, but the subsequent investor that's going to create that big liquidity and return event that we're looking to generate.
And as far as from a customer standpoint, what size? I know there's just so many different varieties, right? You got your smaller units. You've got your where maybe it's just covered RV storage. Like what's a good makeup of, or what I guess maybe when you're developing, are you trying to accomplish? What sells the best, and what are the
that's all
spaces?
That's all market dependent, right? And so every market is going to have an ideal unit mix, and the unit mix will tell you what the average square foot of the units are, of all the units are in a given market, and then what the average rate per square foot should be. So take, for example, a storage facility in Philadelphia is going to have a much smaller average unit size because it's a far denser market, high dollar amount because of the cost of living there. Versus if you go to suburbs and more rural, you've got a lot more, less dense. And so you need to have higher average square foot sizes. So part of the art and science is to understand the market. And as we're developing facilities, there's a lot of input that goes into designing that ideal unit mix to make sure that you're balancing the highest rent per square foot with the lowest average square foot unit that you can get. So that really is going to vary. And that's where we've seen we've turned away or declined putting in offers in newer constructed facilities because they just didn't have the right unit mix. In some cases, you can work with that where you can add some partitions, make the units smaller, make some bigger, but even there's some limitations. So that's where if it's somebody who's not a experienced developer, or they don't use the self-storage folks that build construction facilities or design them for a living, you can add a lot of risk to a project by not doing it right.
Sure. And then what about like climate control, that kind of stuff? I mean, obviously you're going to have a mix of that, but is that, and I was just thinking as you were talking and thinking public storage again, but just some of the facilities that are almost like small buildings, small high-rise buildings. And so I don't know if they're designed that way so that they can be somewhat climate controlled. I've seen a friend of mine that had one that he developed. He had a few in the front. They were air conditioned and that kind of stuff. But primarily it was drive up. You just drive up to open up the roll up door.
Yeah, and that's also market dependent. What is the supply and demand for climate control? And to be clear, when we say climate control in the industry, there's some folks will say climate control, others will say temperature control, depending. If it's true climate control, you're talking about also controlling humidity, right? And that's not typically what most folks think about. It's typically temperature control, right? So in the winter, you don't want the temperature to go below, say, 55 degrees, in the summer above like 85. So there's a big range there. That's also very market dependent, and and then also depends on what you can build. The maximum impervious coverage on a lot, and when you're talking about multi-story, typically they are going to be temperature controlled, because as you go up, you're inside, you got interior units versus drive up units where you're just going to drive. So that will vary depending on the market. If it's a market like Philadelphia in the city, you're going to need more temperature controlled. But if you're out into the suburbs and more rural areas, it'll typically be drive up. So that's, again, going back to how do you maximize the rate per square foot versus minimizing the average size of the unit. Now, what I can tell you is, for the most part, it's about 20-25% rent premium when you're talking about temperature controlled versus non-climate controlled. So, and that can vary if it's on a second floor versus a first floor, if it's close to an exit, if it's interior, and that kind of thing.
Do any of your facilities have like niche type storage? Like, a reason I ask, I noticed one I live in San Antonio, Texas, and I noticed one of them advertising wine storage. And I don't have enough wine, I guess, at the house, because I'm thinking to myself, really, if I'm storing it somewhere else, how inconvenient if I've got people over. I'm sure it's for collectors, but do you see any of that?
We don't have in our portfolio anything like that, but there's, it's the standard. I'm always thinking about what are some of the more, how you can add a little differentiator, how can you anticipate a growing need. We've seen wine storage, cold storage, but that cold storage is its own asset class. Beyond boat and RV storage and some indoor, the only other part is there's some contractor units or more industrial size, big, larger units for contractors and businesses like that. But again, going back to driving, what is the maximum return and yield on a facility? You tend to fall right back to your standard, self-storage. So
sure,
that's a niche area. The wine storage, I would imagine that there's either some data points, hopefully, that they didn't just build it because they thought that there'd be a demand for it, or restaurants or something. I don't know.
Sure. And so in your experience with the ones that you have purchased, as you're deciding what to buy, what is the biggest improvement that you see that you can make? Just updating the technology that's used for it, or in other words, what's the biggest bang that you get for your buck as far as, taking one that maybe was managed by a mom and pop, but they didn't advertise it probably the way they should have, and just from a technology standpoint, maybe it doesn't fit what a lot of the newer facilities have.
So the biggest thing that drives that is revenue management, and it's a capital R and a capital M. So that is its own discipline within self-storage, and that is evaluating every aspect of a facility to maximize income. That includes what is the initial, when you raise rates for a new customer the first time, and then subsequently, right? What does that plan look like? How are you pricing your units relative to where their physical location is, even at the facility? How are you converting leads? How are you generating leads? That in and of itself is where those that really shine in self-storage versus those that do okay, that's the biggest difference. Aside from expansions and all that, where it's huge CapEx infusion, revenue management is is the biggest area, and that's where you need, no offense to those out there that are relatively new to the industry and learning self-storage, because I was that person as well. But that's the biggest difference between bringing in the team that we have that understands, that has been around self-storage for 20 plus years versus somebody that, picked up one of these storage books and understands the concept. It is being able to know those dials intimately and being able to see a P&L and being able to see a unit mix and drive and squeeze every ounce of revenue. So that is a huge differentiator. I thought that I had a pretty good idea of what that looked like and what to do. And as I brought in the team that we have now, it's night and day. And again, it goes to experience operating facilities at big scale, and then having the data to be able to make those intelligent decisions on how to drive revenue. So revenue management, by a long shot, if anybody tells you otherwise, they shouldn't be on your show, but revenue management is the meat of self-storage.
Yeah, and I think one thing that struck me when I was listening to the presentation on one of your deals, I hope I have the right operator and the right deal, but on this, but it was the pricing, just how that can fluctuate. I mean, I've got a short-term rental. It does the same thing with the active, pricing depending on when it is and, what's going on in the area. But I believe that you guys utilize something similar with self-storage. Is that correct?
Yeah, so self-storage is analogous when it comes to revenue management to the airline industry, the hotel industry. It's pricing dynamics. We raise rates on Thursday and we drop them on Monday. It's that granular because you need to understand the consumer behavior and you need to understand where your market is, where your rates are at, and all of that. So it's not a part-time activity. It is a full-time, aspect of the business. So we have the tools and technologies. The more advanced technology allows you to put in rules. If you get to, say, 92% occupancy in any size of a unit, then raise rates 10% and keep doing that until you get to 92%. If you drop, then you want to drop rates. So you can add some dynamic rules in there, but by and large, it's taking a step back and looking at every facility, looking it down to the unit size, looking it down to the very granular level to be able to drive that. And that's where the cream rises to the top. That's where those operators that do okay. Now, it's one thing, like same over the last 10 years, a lot of people made a lot of money in real estate, and that was because a rising tide lifts all boats. I mean, the market just expanded and grew and exponential rates. So it's not difficult in that market for people to make money. It's kind of when things get more where it requires a lot more extra attention. The market that we're in now, the market is very different from a self-storage customer than it was last year. We're trying to evaluate nationally as well. And we're looking at it as, have we, and from COVID, right? What is the COVID behavior? How did that change the utilization of storage? How did it change the absorption of rate increases for tenants? How is that changing now? How is the market dynamics where people are starting to be forced to go back in the office? Those are areas that you have to watch and you have to understand and ask a lot of questions. And if you do that well, you can have a lot of success. But if you don't have the right team to be able to do that, then you're kind of always going to be behind the 8 ball and stuff like that.
Yeah, that makes a lot of sense, man. You've got it dialed in for sure. So it's great to hear.
Try.
Yeah. And then as far as the investments themselves, what does Hearthfire typically do from a loan to value? How much debt? What's kind of the formula that you work off of from that standpoint?
Yeah, so the biggest formula that we evaluate is obviously returns to investors. Our typical deals are 70-30 split to investors, up to a 15% IRR, 8% preferred return. I mean, it's not overly exotic from what else is out there. But then it's about debt coverage ratios. We don't take on debt risk. A lot of sponsors out there, not necessarily in self-storage, although I'm sure there are, but in multifamily just took on a lot of debt risk over the last couple of years just to make a deal work. You take, for example, taking an interest-only loan on an asset that otherwise would never be able to support the full amortized loan. That's just irresponsible. So for us, it's about when we get it stabilized, what is the debt service coverage ratio? And then what kind of interest rate risk might we have? What might we have? Up until to this day, we don't have any debt risk right now because we've took out the right amount of leverage. We've always looked at what is the maximum leverage that we can take out and we can be comfortable, and typically that's 70-75%. But now it's more 60-65%. And then again, it's evaluating what does it look like stabilized? Who are the lenders? We're not using some overly exotic, private lender that has all these clauses with it. We have personally guaranteed the loans on our deals. So you talk about alignment of interest between a sponsor and their investors. There's a lot of non-recourse lenders, and the people that are on the hook, unfortunately, in those cases, are the investors. Right. So to answer your question, it's really about making sure that debt coverage is going to be strong, and we don't just look at, hey, we're going to underwrite it to be 1.25 in terms of debt coverage. We will look beyond that to make sure that there's always a cushion, and then using debt responsibly.
And as far as lenders themselves, are you looking at banks that are in the area, or are there more national lenders that kind of are your go-to, or does it really depend?
It's a mix. In the market that we're in now, we are casting a wider net to make sure that we are truly getting the best terms that the market will bear. But typically, in a lot of markets, local lenders are going to be give you the most accretive loan terms out there. As we're doing development deals and larger deals that are that larger lenders will give you better terms, we're looking at those. But we've got financing with a number of banks, and we've adopted. We're doing our own risk management on the institutions that are lending us as well. Things like SVB collapse and First Republic, and those guys that got into a little bit of trouble. If you're not evaluating, if they're just giving out loans, without a whole lot of due diligence and make it easy, then we've got questions. So we evaluate the lender just as much as they do us now.
Yeah, that's very wise. You mentioned at the beginning about self-storage and, looking at the market and if it's X amount of renters, that kind of thing. And I just wonder, I'm sure renters play a role in it, but from the landscape of self-storage, is it usually a percentage of renters versus property owners? Is that kind of?
So we like to see like a 30-40%, of a given market. If they're that high in terms of the number of renters, that means that the self-storage utilization is probably going to be high as well. So that is not, we have all of our metrics, and then we take them in totality. And so one threshold might fall below a certain threshold. But as long as it's not way off, then the other factors can weigh a decision and moving towards an acquisition. But there's no, and then we're also looking for what new supply. So if I'm looking at self-storage in a given market, how much new housing is being built, how much new employment is coming into that market, what are the trends in terms of population, median household income, new developments, single family, multifamily, renters, that kind of thing. So as long as we're seeing all of that growth in a market, then that's going to tell us that storage has got a good chance of being successful in that market as well.
Fantastic. Well, we're running just a little long on time, but I've got a few other questions for you. Wanted to, outside of when you're not doing real estate, what do you do?
So I'm a family man, first and foremost. As a family, we were talking before we got on the call. We love the outdoors. Anything nature driven, whether it's a hike, whether it's gardening. I love grilling and smoking meats, and anything that I can do to learn something new. I love. I'm notorious for starting new hobbies and trying them out. I love personal growth. So anything that's going to expand my view into the world. Got a beautiful 6-year-old little girl. So part of a big core value of ours is just life experience. We're very active in our church. We lead by example for each other, for my daughter. So we're very active. It's all about giving back. I mean, we are blessed to be part of a fantastic world that we live in spite of a lot of the challenges out there. So it's experience all that, the great things that life has to offer, and then sharing them as much as possible. So I don't have any single hobbies where you'll find me, I golf, but I'm not a golfer. I just find that it's entirely too much time and too much time commitment. So I'm a family guy.
Yeah, that's great. And then as far as if you were to have some advice for maybe somebody who's just starting out in their investment journey, or maybe, a lot of our audience, they have their company match with their 401k, that kind of thing. But beyond that, they really haven't necessarily experienced in real estate. So what kind of advice might you have for them?
So, it really comes down to, if you're talking about investment goals, it's number one is follow your passion, right? Don't invest in something because it sounds good or you're even interested in pursuing, whether it's, oil and gas. If you don't have a passion for learning that part or that industry inside and out, then don't dedicate any time to it or certainly investment dollars. I'm a big believer in the number one thing to invest is in yourself. Personal growth, your overall health, your spirituality, living life to the fullest. Beyond that, it's a matter of understanding where you're at in life. If cash flow is a priority, if growing your equity is a priority, then you understand all that there is to know what does it take to invest in any given thing, and then how to properly allocate your funds. If you don't know anything, then find somebody or don't know a part of any decision that you make, then there's so many resources out there to find it. I'm a big believer in learning how to ask the right questions. That's huge. In fact, if you're following the developments in AI and Chat GPT, there's a whole new industry that's come out with prompt engineering. And really, that's just how do you ask the right questions to a bot to elicit the right answers? That's a whole different dynamic than doing a Google search for restaurants near me, right? And things like that. So to me, asking the right questions, we're big believers in now looking at classical education for our daughter, things that involve more critical thinking. So thinking critically about what you want to do. Don't dive into anything that is, you just heard a great idea. I heard even me on Keith's podcast, and now all of a sudden I'm going to go out and buy self-storage facilities. That's not very responsible. Before we did it, I read every self-storage book that there is, made sure that, hey, this is something I'm interested in. This is something I believe in. And then from there, surrounding yourself with the right people and education and learning as much as there are about it. There's a lot to be said about not just making decisions, but making confident decisions are paramount to being able to sleep at night, because at the end of the day, peace of mind and being able to enjoy what we do is really the most important thing.
Yeah, I agree. I got one last question for you, just a book recommendation. So obviously you're a reader and self-development and everything else. It doesn't have to be a self-development, but just any books that you recommend. This is really for myself, not so much for the audience. I love to see if there's something I haven't. So
I'll give you a couple answers. For one, a book, an actual book that I read that was very instrumental in this stage of my growth is Faster Than Normal. If you have any idea or any thoughts that you may have adult ADD or kind of all over the place, that's definitely a book worth reading. It kind of changed my life. And then anything on mindfulness, working on being present is really critical. If you want to shoot me an email, or you could maybe even share a way to get that out to your audience. I wrote a paper. I've been meditating and focusing on mindfulness for over 20 years now. I went through an anxiety period of my life and have overcome that. And I find that being mindful and present about what I'm doing, how I'm feeling, my emotions, and then being able to navigate my energy and channel that in a way to manifest what I want out of life is tremendous. So there's a lot of resources. There's a lot of fantastic teachers and guides there to be able to direct. So I'm a bookworm, man. I won't rattle off the Rich Dad Poor Dads. I'm sure that you get that every
right.
But yeah.
Okay. Well, why don't we end with just how people can find out more about you?
So a couple ways. Connect with me on LinkedIn. You can find me on LinkedIn. My email is sergio@hfireholdings.com. Our website, you can easily go to Invest with Sergio. That'll take you right to our website. Join our mailing list and shoot me an email. I'm not one of those people that's too busy for others. I love sharing what we're doing. I love sharing what we're building. And quite honestly, we love helping, even if it's a matter of evaluating investment opportunities from someone else. Give you an honest opinion if you want it. Can connect you with different people that we know. We pride ourselves in being super helpful and friendly and giving back to all the people that have shared with us. So anything that I can do, always glad to help.
Awesome. Sergio, I've really appreciated it. And I think there was just a ton of value, and you really opened my eyes to a lot of the ins and outs of self-storage. So really appreciate you being on the show.
Thanks, man. I appreciate it.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.